Hey everyone, welcome back. CPI data came out, and guess what? It was worse than expected. The numerous analysts, the fund manager, the Wall Street estimates, everything was out the window because they were thinking that, you know what, CPI data is going to come less. The core CPI is going to come less. The headline CPI will be more, but overall CPI will be less. But guess what? None of that happened. And we saw this huge increase in the CPI data. Now, I wanted to break this down. And when I read the report, it was very obvious that Wall Street got it all wrong. But there is a huge important message in today's CPI, and it's kind of a good news for me. And why is it good news? I'm going to explain it to you. So let's do this. I'm going to share the chart and I will share my research on the CPI data. We are going to go over some of the numbers. Then I'm going to come back in the camera. I'm going to go off the camera because I want you to focus on the chart and the images that I have for you. Then I'm going to come back in the camera and I will share my viewpoint why this is a bullish sign in the long term. Short term, we are going to see pain. Short term, we are going to see that, you know what, we might not see what we expected to see from the stock market. But guess what? This is a good thing, in my opinion, because now market is pricing more and more things in it. The decline that we saw today or the sell-off that we saw today, Tesla right now at 695, it kind of maintained that level. I was actually expecting a worse day. To be honest, I was thinking that we are going to see worse day. But guess what? Over and over again, we have seen that this is not just one data point. What I mean to say is that CPI is not the decisive factor of how we are going to go in the stock market or how the US economy is going to come out. We have many things coming next week, which I'm going to talk about in the video as well. So let me quickly share the screen and yep, you guys can see. Okay, so I'm recording from my office. So if the clarity is not there or if it's good or bad, just let me know in the comments. Okay, so as you can see over here, this is the CPI data that came out, and we had about 8.6 CPI, which is year over year, and we were expecting about 8.3. Some of the main points were, and I'm going to go over, is that the forecast range was 8.6%, estimate was 8.3%. CPI, excluding food energy, month over month, rose 0.6%, estimate was 0.5%. Excluding food and energy, year over year rose 6%, estimate was 5.9%. So again, it came hotter than all the level as compared to the estimates. Food index increased 1.2% in May after rising 0.9% in April. This was a massive increase, and we knew it because food, energy, we feel the pain. When we go to the grocery store, we feel the pain. Now, energy increased or energy index increased 3.9% in May after falling 2.7% in April. Again, April was a good month for gasoline or for basically energy because the prices went down, but then May prices came back up and they're still elevated. Owners equivalent rent of residence increased 0.6% in May after rising 0.5% in April. So if you look at all the factors, everything was basically higher than the estimates. So the May CPI sets a new 40-year record of 8.6. It was worse than expected CPI. Of course, it's bad for the Fed and for the White House. Of course, Treasury, dollars, they all rise and stocks were falling as we see or as the data came out. Now, we still, this is what analysts are now saying, that we still don't think that the Fed will seriously consider 75 basis point hikes, but the market may price for the possibility. And I'm reading you this straight from Bloomberg. And basically, they're talking about that, you know what, we don't think Fed is going to come out and they're going to give us the 75 basis point hike, but market may price for a possibility. And this is one of the good news that I mentioned, that this CPI reading has some good news in it, even though the reading is all bad everywhere, but we see some good over here. Okay, along with that, let's take a look now to the next thing. So the next thing I want to show you is this. So we have this right here. This is the chart, and I think this is the max I can go. Yeah, I'm sorry if you can't see clearly, but this is the red that you see over here. It's basically the temperature or how hot the things were. And the size of the box represents each component's contribution to food, and the color of the box shows that month over month change in the price. For example, the eggs over here alone was up 5% in May from a month before. This is crazy. So if you look over here, chicken, poultry, eggs, this is all necessity, right? I mean, like people eat that day in and day out, and this is really red hot red. Over here, milk, Other dairy products, red hot red month over month. Bakery products, red hot red over here, like bread and different bakery stuff. But then snacks, food at home, other food at home. This is all basically soups. This is all less because the people are getting away from this. They're not spending money over here, but they're putting more money over here. Okay, so this is a true picture of the market of what's going on. I mean, if you think that inflation has peaked, just look at this here. I mean, recession, people say, is not in the books. We might, some people say that we might not get into the recession, but look what's happening here. People are not spending money in soups and snacks. They are basically spending money in chicken and eggs because that's the necessity, in poultry and the stuff like that, coffee, carbonated drinks. So this shows that how the behavior of the consumer is shifting to more of the necessity items. And this is the chart over here, basically -2 to 2% gain or over here on the scale. So month over month percent. So you can see that eggs alone was up 5% in May, which is of course a very huge increase for somebody who is eating eggs day in and day out. I mean, I'm one of the consumers. I love eating eggs, and so one of the lessons that I feel we have learned over the past year is that any single data point has been shown to be vastly not conclusive. Like, it's not correct. We are going to be looking at Tuesday, we have a PPI number, which is coming. Then Wednesday, we'll get the retail sales data and some more, of course, commentary from FOMC, what they're going to do with the rate hikes. And what we are doing every week is basically really looking at all these data points, all these elements, combining together and then making sense that where do we see the economy or the price go from here. And that's the interesting part here. We are going to continue to see, and we are going to digest those points as we go when more and more data points come out. So for us to stand here and say that, you know what, this is an amazing time to buy right now because we have hit the bottom. No, we have not, because we have a lot more data points that is coming in the next week. And again, I'm going to say that again, that my price, or not price, my date where I feel most comfortable going in is 15th, when we have that FOMC, because we are going to have the retail numbers by then, of course, and we will have the PPI number by then, and then FOMC will give us some direction of where to go. Now, then 15th of June can become 20th of June. Absolutely. If the market doesn't react the way that I think it should react, then I will wait. Of course, nobody's putting gun to my head. Okay, now let's take a look at this chart. So the graph that you see here is the price pressure of between how goods and services. So core goods and core service. So if you pay attention, just this time right here, we have shifted from goods to services. That means services is hitting or is more hotter than the goods because of all the travel or the fun stuff that we are doing. That's why the goods is coming down, but the services is running hot, and the services is continue to run hot in the summer months because travel and everybody is going out and about. So this is a shift where we were thinking that, you know what, we are going to see a cool down CPI, we have peaked. No, we have not really paid attention to the services sector, which is, of course, is right now very hot. If I look at the numbers over here, if you pay attention, look, food 10.1, food away from home 11.9. See that? So people, as they go out and travel more and more, this pressure of the services industry is also going to come more and more. Now, take a look at this chart. And this was a very interesting chart because it takes all the way back from 2013 to 2022 right now, and see the progression of these lines. So the orange that you see is food contribution to CPI. The blue that you see is energy contribution. Shelter is the red. Used car and trucks is the green. And then all items less food, energy, shelter, and used car is the white right here. So look what's going on. One can see that, of course, the contribution from used car and truck is starting to come down. If you can see over here, used car and truck, as you see, is a huge drop over here, but the energy is going up, right? So one thing taken down, supported by the next thing. Look what's going on with shelter. Shelter is also running very hot. Even though everything else, excluding these four things, is coming down, if you see, we have a downward trend right here, but everything else is running so hot. Look at the food contribution. Food contribution is running so hot. So if energy is up, the food is going to be up, and then shelter is going to be up. So it doesn't matter if one sector is doing good. Some of them are saying, well, used car prices have come down, and and our supply chain issues is going to get better. But I think food and energy inflation will continue pushing to new highs in the coming months, especially as we are into the summer months. So If somebody can come out and say that we have peaked inflation, I'm not going to take that person seriously for now, because I feel that these three sectors that we have, energy and shelter and of course food right here, is continue to keep going up because of the interest rate going up, because people are not spending money. So this is the true picture of where we are right now. Now, how is that a good thing? And I'm going to quickly go what I don't want to make this video too long, but how is this a good thing? Okay, so the market's rate expectation for this year have increased to a new high right here. So now traders are expecting the Fed to hike more than 200 basis point hikes in the next 5 meetings to push the benchmark rate to about 3% by December. So this market is now pricing in, and I'm going to now actually come back in the camera. So this is really, in a way, good thing that it happened now, because if it would have, the CPI data would have come down, let's say 8%, that would have been fake, because energy and food is continue going to go up. So having the CPI data come out hotter this month sets the expectation straight. And basically, traders are now seeing a possibility that Fed will continue raising the rate to up to 200 basis point, and by December. Before they were saying June, July, after that, and September, Fed is going to stop. That's not going to happen now. Fed is going to continue to go up and keep adding the 50 basis point increase every month, every month. And if they come out now, what has not been priced? Okay, what has not been priced in one is 1 basis or 100 basis point increase or 1% increase. 0.75 is also priced in. So as we get these bad numbers, it's really bad right now where the market is looking right now. It's kind of good because now we are pricing in these things. I mean, I was just chatting with one of my friend, and I just basically told him, I was like, how long can you cry? After a while, you're like, you know what? F it. I'm not going to cry anymore, and I'm ready to actually buy. And this is what's happening right now. I mean, I'm fed up of these numbers and the market swings and all that. So one of our Discord member asked today that, hey, are you buying or doing anything? I'm like, I'm just watching right now, because I know that market is going to get another shock. This sell-off today was nothing. I was expecting a much major sell-off in all. I mean, right now, if I see over here, let's see if I can pull out what S&P is doing right now. So actually, I'm going to check my phone here quickly. I turn everything off. Airplane. Okay, so Tesla is down like 2.43%. I mean, it's nothing. I mean, if you look at the market, S&P is down 2%, Nasdaq is down 2.7%. This was nothing of a shock as I expected we are going to get if we get bad CPI. That means that market has priced in these shocks. That means market has realized that, you know what, this is a norm. We are not going to see a major change in the coming days. I think we are going to see July CPI will be worse when it comes out, because that's the peak. You know, everybody is right now still getting off the school, and then they're going to travel and all that stuff. And energy prices is not going to cool down anytime soon. So this is going to be very interesting on how we are going to navigate the next few pieces of news that we are going to get. But every piece of news that we get prepares us, or prepare us as retail investors and traders, to basically price some of this in. And that's why it's exciting for me, somewhat exciting for me, as we enter the market, because market is always forward looking. It's not looking today, it's not looking back, it's looking forward. So if it's pricing in all those things, and when those things actually end, when Fed stops raising interest rate hikes, that's time when we will see market has already priced that in. Okay, by December, Fed is going to stop raising the interest rate, and then the bull rally might come in August or September, depending on what the market condition is, Russia, Ukraine, so many variables out there. So I hope I provided some value. And if you like the video, then definitely comment in the video and let me know what are your thoughts about the CPI data, and also where do you see economy in the next few months, and also how you navigate the second half of 2022, which I think is very, very important for us investors. Again, thank you so much. Pleasure to share all of this with you. Until next time, you all have a sparkling day.